episodes are hype fueled, but listeners, this one asks for a deep breath. Now, money conversations can trigger hope, fear, or both, and crypto turns that dial to max. Today, on this episode of BizBlend with your host Sana, we are not here to crown heroes or burn villains. We are here to understand method, mindset, and risk. Listeners, my guest, Niko Mercuris, founded Crypto Renegades, which is a high ticket futures trading mastermind with 1,600 plus paying members. He rebuilt after losing $4 million in the 2008 crash, trades live, wins and losses included, and teaches his crypto wormhole method. So, before we dive in, listeners, all I want to say is this conversation is educational, not financial advice. Futures are high risk. Please do your own research and protect your downside. With that grounding, let's explore what's real, what's replicable, and what it actually takes to trade with discipline in a volatile market. So, Nico, welcome to the show, and I'm really, really excited for this conversation.
Thank you, Sana. Me too. I appreciate your time and welcoming me to your show. Looking forward to it.
Absolutely. Okay, so of course, Nico, if you can walk us through your crypto wormhole method, what was the origin, what exactly it is, and in a plain language, and if we
Yep.
can share, like, what are the exact steps a member, like their journey, from scanning the market to placing and then matching and exiting a futures trade.
Yeah. So the name crypto wormhole and the crypto wormhole method, we coined that phrase because what we're really doing is we're teaching people how to collapse time. And if you remember, people who are old enough remember the old Star Trek movies where,
Yeah.
Spock they would go through a wormhole and they would be, 20 billion miles away and another galaxy. And so the wormhole can get you somewhere far away very quickly. And that's kind of the method that we use here, and we use leverage to do that, but we do it in a safe environment. So a lot of people are scared of leverage. Leverage just means that you're using OPM, other people's money, to a
Mhm.
degree. Kind of like with real estate, if you wanted to become a real estate investor, which I am also, and you wanted to buy a house or flip houses, for instance, and there was no leverage and you weren't able to borrow any money, you would have to save up all the money yourself. It could take people years and years or decades to come up with $500,000 to pay cash for a house. Some people would never be able to do it. And, however, leverage allows you to borrow 80, 90% from the bank and you put down 10, 20%. So on a $500,000 house, you would put down 20%, which is $100,000. You buy the house, the bank loans you the other 400,000, and you now technically own the house. If 10 years go by, and I know here in
Mhm.
Florida where I live, the appreciation of real estate is about 10% per year. 10 years go by, that house that you bought for 500,000 is now worth 1,000,000. And,
Hmm.
however, you only put down 100,000 of your own money, so all of that appreciation, all of that extra, equity is yours as long as you didn't default on the loan. You can
Hmm.
refinance that house, you can pull the equity out in a form of a loan, tax-free, use that money to buy more real estate, and so on and so forth. So that's leverage in real estate. In crypto, very similarly, you put 5,000 or $10,000 into your trading account, and
Mhm.
let's just say you're in our group, we teach you how to use proper risk management. So I would say if I give you a signal and I say, I think Bitcoin is going to go up by 1 or 5% today based on the technical analysis, based on support and resistance, where we see the price heading today or this week, I think we're going to go up 5%. So let's just say you had $10,000 in your trading account, but you don't want to risk $10,000. You want to risk maybe 5 or 10% of that. But for the sake of this example, let's just say you risk 10%, which is $1,000. So you go long on that trade signal that I give with $1,000. So that's all you have at risk, but you're going to use 20x leverage. 20x leverage now means that you take the $1,000 that you're risking, multiply it by 20, and that's
Mm.
the amount of contracts that you're actually trading with, which is $20,000. But the most you have at risk is your $1,000 margin. But to go even further, we're going to put a 10% stop loss on the margin, which means that if it goes against us and it doesn't go the way I want it to do, it goes down instead, you will get stopped out, meaning it will hit your stop loss at 10% of your $1,000, which means you only risk really $100 on this trade. So you're playing with a 20,000, you're risking 1,000, but you have a stop loss at 10%, which is only 100. So the very worst case scenario on this trade is that you lose
Mm,
$100. But if it does what we want it to do and it goes up the 5%, like I think it will, then you're
mm,
going to make 5% on your $1,000. That's 5% move in the market times
mm.
20. Okay, because we're at 20x leverage. So
Yeah.
if you without the leverage, without the wormhole, we're not going anywhere. 5% on $1,000, not much money. That's only 50 bucks, right? But at 20x leverage, you're making $50 times 20, which is 100% gain on the 5% move. So you're making 100% gain on a 5% move in the market. That's why we call it the crypto wormhole, because we're collapsing time. We're allowing you to make a lot more money in a much shorter period of time than you normally would be able to do without that leverage.
Hmm. Yeah.
Still probably confusing to some, but I'm sure, but the reality is that when you look at billionaires, for instance, I use those as an example because not everybody wants to be a billionaire, not everybody cares. But
Okay.
if we look at how billionaires became billionaires, most of them, or even just millionaires and deca millionaires and 100 million plus people, they use
Mm,
leverage. Donald Trump borrowed hundreds of millions of dollars from the bank to buy more real estate. He leveraged that bank's money, investors'
mm,
money. He acquired the properties. He increased the value of the properties by improving them. He refinanced them at a much higher value, pulled all the
mm,
equity out tax free. That's how he claims that he pays no taxes. And then he lives his lifestyle off that borrowed money. But a lot of people are like, well, isn't that dangerous? Don't you have to pay that back? And the answer is yes, but the tenants are paying that back, not Trump. His tenants that occupy those rental properties pay the mortgage, pay the rent every day, and that money goes to pay off the loans. And then he'll take that money and buy more properties. So he's constantly leveraging other people's money. Elon Musk, when he bought Twitter for
yeah.
$40 billion, he borrowed all the money against his stock portfolio from his Tesla stock and from his
Mm,
SpaceX stock. So he used borrowed money. That's leverage. Jeff Bezos, when he bought his $200 million yacht, he didn't sell his stock to get a capital gains tax on $200 million. He borrowed against his stock portfolio tax free, bought the $200 million yacht, and is paying that loan back with the increased value of the asset that's being held as collateral, which is his stock portfolio. So as that goes up in value, he just pays those loans off with that money. And so the rich people have been doing this for many decades, many years, 100 years plus. And most people just are scared of debt. They're scared of leverage because
mm.
leverage can be dangerous if you don't know how to use it and you're not using it properly.
Exactly. Exactly. I think that makes it very, very clear, Nico. Very clear. And yeah, I mean, thanks for breaking down because this is not about vibes, but it's on rules, on careful calculation of everything. And I think for listeners, there's definitely a checklist here, not some kind of luck or magic, bad signal. So I think that really, really lays the foundation here, Nico. And let's say, I'm a complete beginner into this. So as a beginner, where would I probably misinterpret your method, the crypto wormhole method? And what's the correction? What is the correction here that prevents any avoidable losses here?
So that's a great question. And new people get scared. They're very intimidated by the trading markets because it looks complex and it looks very intimidating. And I think it's intentional, to be honest with you. The multimillionaire traders of the world, the stock market traders and the hedge Wall Street hedge fund managers who make hundreds of millions of dollars a year trading, they keep it confusing and very complex looking for a reason. They don't want, it's their own little club. They don't want everybody getting involved probably. But the reality is once you understand how to enter and exit the market at the right time, you can literally pull money out of the ethernet uh, anywhere you are, as long as you have an internet connection and a device. You don't need a product, a service. You don't need a job. You don't need to go to work in a car. You don't need to fight traffic. You don't need to talk to anybody. You don't need to sell anything to anybody. You simply need to know when to get in and when to get out. The market is fluctuating every day, up and down 1 to 5% every day, all day, every day. And so if you miss an opportunity, there's another one coming in 15 minutes. It just never ends. And so the truth is that you can just open up an account, deposit money, and throw a dart and basically just guess. And you have a 50% chance of being right. It's either going to go up or down that day, right? So
Mm,
now when you get a little bit more skilled and you understand what we teach is we teach price action and what's called technical analysis. So we're looking at the chart and we're looking, where is the support? Where was the low of the day in the last 24 hours? Where was the high? The high is the resistance, the low is the support. We're finding exactly where the support and resistance is. And then we're looking at the current trend and we're looking for a trade setup. A trade setup is when the price is winding into an apex or winding into a, a a wedge. It's either going
mhm,
to break out of the top of resistance or the bottom of support. And so we're waiting. We just wait for that to happen. And once it does, it breaks out to the top. Let's just say we go long, we put our stop loss in place, we put our take profit target in place, and we wait for it to either hit our take profit target or go enough into profit that we can move our stop loss into profit. Once we do that, it's a no risk trade. We are risking zero at this point, and we have all the potential upside, all the potential gain of the upside, but none of the risk of the downside because we've already moved our stop loss into profit. Now,
mm,
if we enter a position and it goes against us right away because we made a mistake or we didn't calculate properly, we still have our stop loss in place, and the stop loss is named for exactly what it does. It stops the loss. So it's meant to take you back out of the market, take you out of that trade with a very small loss instead of a large loss. And so let me just put it this way real quick for you is that if you have $10,000, let's just say in your trading account and you're risking 10%, that's $1,000. But if you put a 10% stop loss on that, you're really only risking 10% of your $1,000, which is $100. So
I see.
the most you're risking on any given trade is 1% of your entire account balance, which is very small, which means you could lose 100 trades in a row before you go through your entire $10,000. Now we have a 65 to 75% win ratio in our group. So we're winning trades 65 to 75% of the time. And so
Mhm.
very unlikely that you're going to lose 100 trades in a row. But if you use proper risk management, meaning 10% of your account balance, 10% of that as a stop loss, you're risking only 1% of your entire account balance on a trade. You can live to trade another day when you have a loss. You have a small loss, no problem, get into the next trade. You have a small loss, no problem, get into the next trade. You have a small loss, no problem, get into the next trade. Chances are you're going to have 6 or 7 winners in a row after that. Out of 10 trades, 7 winners, 3 losses. And so if your winners are $500 profit per trade, but your losers are only $100 loss per trade, you take 10 trades, 70% win ratio, you're making $3,500 on the winners and you're losing $300 on the losers. So you're
Mm,
up $3,200 out of those 10 trades. So there is risk and there is some losses that are going to happen, but we keep the losses very small and we try to maximize the gains.
mm. I think that really makes sense because we definitely would we would definitely want to know both sides of the coin here. Like, if we are celebrating big wins here, we also need, like, crystal clear language on risk and realistic baselines. So I think that really, really lays the foundation here, Nico. And also, most people, they don't blow up accounts because of the chart. They blow up because of impulse, and this somehow connects with the kind of the error or that uh, you know misinterpretation that you mentioned, and then there's 50-50 probability in there that you hit the dart in there. So what behavior design systems do you require, for example, like checklists or time boxed sessions or any kind of pre-commitment contracts like
Yeah.
that reduce emotional trading?
Great question, because the majority of the problems that people have when they trade is all in their head. It's all emotion. It's fear and greed. These are the two major emotions around money. People are fearful of loss, and they're also greedy. So greed, and there's nothing wrong with this. These are human emotions, but greed means basically when you're trading is that you're trying to hit a home run. You want to make as much money in the shortest period of time possible, instead of just being happy with your little 10% here, 20% here, 30% here, and doing that over and over and over until your account grows and grows and grows. A lot of people
Mm.
come in, they put 10,000 in their account and they want to double that on their first trade. So they risk it all and they try to double it really quick and then they end up losing half of what they have. And so if you can just control the fear and greed factor, the fear is a lot of people are scared of losing money. So they get into a position and it goes into profit. And instead of closing out the trade in profit and having a win, what they do is they they say, "Oh, I'm in profit now," and then the greed kicks in. So they double the contracts. They
Yes.
increase their leverage because they think, "Oh, I'm in profit now. I didn't risk enough. Now I'm going to risk more." So they go ahead and increase the amount that they're risking, and then the price turns on them and starts to go back down, and it goes below their entry, and now they're negative. And instead of holding the trade and waiting for it to turn, they get out at a loss. That's fear. So they're jumping out when they're losing and they're not getting out when they're winning. So this is a psychological thing that people have to learn. It almost sounds moronic. It almost sounds like who would do that? But this is very strange phenomenon and it happens in the casinos as well, like in Las Vegas. People are
Mm.
more addicted to losing than they are winning because when they're up and they win $500 at blackjack, they don't leave the casino. They think they're on a winning streak. So they then take their winnings and they go and try to make more with it and they lose it all back down to zero. And then they want to make that back. So they put more money in and they try to win that back and they lose even more and they leave in debt instead of with the profit that they had when they were up. And this is just a strange phenomenon. So once you understand your own mind and you can control your own emotions, you will become a very good trader by just following the simple price action strategies.
I think that's a very basic, very it sounds simple, but I think it's a very fundamental, crucial mantra. Especially when it comes to trading.
Yeah.
Uh, yeah, I that really, really makes a lot of sense in there.
I tell people a lot that it's like learning how to drive, and you probably remember when you were 15 or 16 years old, when you learn how to drive, you're very nervous. You're scared. You don't know what you're doing. I learned how to drive in a VW Volkswagen Bug, and I had a stick shift, and it was like in the 70s, so it was very nerve wracking. And the instructor was telling me to put it in first and let the clutch out slowly. And I was stalling the car, and then I was supposed to pull out on the main road, and I stalled again, and cars were honking at me. I was having anxiety. I was looking in the rearview mirror, making sure I was doing everything right, trying to start the car. Very nerve-wracking at first. But 30 days, 60 days later, you're doing 60 miles an hour around a corner, steering with your knee, eating a cheeseburger in one hand and a soda in the other, and you're not even paying attention. And that's how quick you learn how to understand things from not knowing anything to really getting good at it to where you don't even have to think too much. And it doesn't take that long. I would say within 60 days, our members are becoming consistently profitable at $200 to $300 per day on average, and that's what we actually guarantee. We promise that we get you to a minimum of $100 a day in the first 30 days, $300 a day in the first 60 days. But we've had members that made 20,000 in the first month and 250,000 in the first 4 months. So we like to talk about minimums and we don't like to overpromise, but we've had several people become multimillionaires in their first year. And but in the beginning, they were very nervous. They didn't know anything about anything, and they just had to take the steps and learn. And once you understand the technical part of it, the basics of actually entering and exiting, then it's a matter of just controlling your emotions.
Definitely, definitely. And Nico, before we wrap up, if our listeners they would like to explore more about the crypto wormhole method, and they would also like to connect with you, what would be the easiest medium?
Yeah, well, I'd like to, invite your members and offer a special offer to them. We did put together a 5-day workshop where it cost almost $1,000, $997 when we marketed that. I'm willing to give that away to your members. They would just need to reach out to me. I would say social media, anywhere on social media, Facebook, YouTube, or Instagram. But if you go on Instagram, you can just search my name, Niko Mercuris, and I think you'll have the correct spelling somewhere on here, but you wanna make sure that you find the profile that has the little blue check next to it because I am meta verified, and the reason why I have to be is because there's some imposters out there that have, pretended to be me to try to scam members of our Facebook group, so be very careful. That's the nature of the business because it's so lucrative, And so you got to be
Yeah.
careful. So make sure you find the real me with the blue check. Send me a DM or comment on uh any video or post that I ever made, and just put the word podcast. You can put Santa's podcast on here, Santa's name, and or the name of the podcast, and I will give you a link not only to the free 5-day workshop, but also a link to the upcoming live free webinar and workshop that we do. I'm usually on for 2.5 hours trading live, sharing my screen, explaining exactly what I'm doing. I'll be making hundreds, probably even not thousands, right in front of your eyes, showing you how we do this. And you will get a much better understanding by watching me actually do it rather than just hearing me talk about it. So, yeah, just reach out to me, send me a message, and I'll be happy to give you both of those links.
Super. That's so generous. And listeners, I'll bear the responsibility of having all the correct links in the show notes. So just refer to them along with this episode on your favorite podcast platform. And I think for me personally, and I hope for all of your listeners, I think the key takeaway here is no strategy outruns poor risk management, and no community replaces your responsibility to run. So I think we have covered method, math, the messy middle. And if you felt both inspired and slightly uncomfortable, that is good. That tension is where honest decisions live. So, Nico, thank you so much for being very transparent and very, very insightful about process and pitfalls. Thank you. This was really, really much needed.
Thank you so much. Appreciate it.
So, to our listeners, this is education, not a signal service. So, if you explore futures, set limits, get mentorship, and protect your peace. Until then, I am Sana, and this is BizBlend, where big claims meet bigger questions, and hype has to earn its keep. Catch you next time. Thank you.